Let's talk about one of the biggest line items on your budget, your employee benefits plan. For most businesses, that annual invoice feels like a black box, right? It's this huge, unpredictable expense you just have to pay. But what if it didn't have to be that way? Today, we're going to crack open that box and look at how a self-insured model, specifically something called an Administrative Services Only, or ASO plan, can put you back in the driver's seat. Does this question feel a little familiar? Yeah, for a lot of business leaders, this is a yearly headache. You get the bill, you pay it, but you're always left wondering, where is all this money actually going? And why does the price seem to jump up every single year with no real explanation? And you know what? You're not wrong to feel that way. With a standard, fully insured plan, you're pretty much trapped. You're dealing with those sudden premium hikes, you have zero visibility into the actual costs, and you get that nagging feeling you're paying a fortune for benefits your team doesn't even use. It's like you're stuck with a one-size-fits-all plan that really fits nobody. So, here's our game plan. We're gonna really unpack this. First, we'll pinpoint exactly what's broken with traditional plans. Then, we'll introduce this ASO model as the alternative. We'll put them side by side so you can see the difference. We'll tackle that big, scary question of risk. And finally, we'll help you figure out if ASO might just be the right move for your business. Okay, so let's dive into section 1. The root of the problem with the traditional model is really simple. The moment you pay that premium, you're also signing away all of your control. This right here, this says it all. You see, with a traditional plan, you're paying an insurance company to take on the financial risk. And that sounds good, right? But what it also means is that they get to keep all of the reward. So when your team has a healthy year and claims are super low, does your bill go down? Nope. The insurer just pockets the difference as pure profit. You pay that same fixed amount no matter what. And get this chart shows you exactly where your money's going. For a typical small or medium-sized company, a whopping 25 to 35% of your premium never even goes toward claims. It's eaten up by the insurer's administration fees, their overhead, and, of course, their profit margin. Just think about that for a second. Up to a third of your benefits budget is gone before a single employee even makes a claim. Okay, so if that's the problem, what's the solution? Let's talk about the Administrative Services Only model. This is a completely different way of thinking. It's all about paying for what you actually use. So what is ASO? Here's the big shift. You stop writing huge checks to an insurance company. Instead, your company funds the plan directly. You only pay for the actual health and dental claims your employees make, plus a small, totally transparent fee to an administrator who handles all the back-end stuff. And how it works is really simple. First, you fund the plan. Second, a specialist called a third-party administrator, or TPA, basically acts as your outsourced benefits department. They handle all the claims, the paperwork, the employee questions. You pay for the actual claims plus their admin fee. And here's the kicker, step 4. If your claims end up being lower than you budgeted, that surplus is 100% yours to keep. All right, let's really make this clear. We're going to put these two models side by side in a head-to-head comparison. First up, the funding model itself. With a traditional plan, you're paying fixed premiums every single month. Predictable, but rigid. With ASO, it's variable. You're paying for actual claims as they happen. You're only paying for the care your team actually needs and uses. Now, what about that surplus? This is huge. In a good year with low claims, who wins? In a traditional plan, the insurer's profit margin gets fatter. In an ASO plan, your company's bottom line gets healthier. You keep every single dollar of those savings. And flexibility? Well, traditional plans often lock you into these preset cookie-cutter packages. ASO, on the other hand, is like a blank canvas. You get to design a plan that actually aligns with your business goals. Want to offer amazing mental health support to attract top talent? You can do that. Need a different plan for your exec team? No problem. You get to build exactly what you need. And let's come back to those fees, because this picture is worth 1,000 words. You're going from that massive 25 to 35% overhead with a traditional insurer, all the way down to a much more palatable 12 to 20% with an ASO administrator. That difference isn't just a number, it's pure savings that go straight back into your business. Okay, I know exactly what you're thinking right now. Self-insuring sounds risky. What happens if we get hit with a really huge, catastrophic claim? It's a fair question, so let's talk about the financial safety net. This is, without a doubt, the number one concern leaders have. And it's absolutely the right question to be asking. The idea of being on the hook for $1 million claim is terrifying, but the ASO model has a really smart answer for this. And that answer is something called stop-loss insurance. The easiest way to think about it is it's insurance for your self-insurance. You decide on a dollar amount per employee that you're comfortable covering, say $10,000. The stop-loss policy kicks in and pays for everything above that threshold. It puts a hard cap on your financial risk. And don't think this is just a tool for giant corporations. For small and medium-sized businesses, you can get stop-loss protection that kicks in at levels as low as $5,000 per person. This is what makes ASO not just possible, but safe and totally viable for companies of all sizes. It's the best of both worlds, cost control and peace of mind. ASO also gives you options for managing your cash flow. If you like predictability, you can go with a budgeted ASO. You pay a steady, fixed amount each month, just like you're used to, and then you just settle up the difference, whether it's a surplus or a deficit, at the end of the year. Or if you have strong cash flow, you can do a non-budgeted plan and just pay the actual claims as they come in. You pick the model that fits your finances. Okay, so we've covered a lot of ground. It all comes down to this. Is an ASO plan the right move for your business? Let's run through a quick checklist to see if it's a good fit. So just look at this list. Are you nodding your head? If you're a leader who really values financial control, if you crave transparency, if you want the power to customize your plan, and if your company has a reasonably stable claims history and you're comfortable with a level of risk that is actively managed and capped, well then ASO is probably a fantastic fit for you. And what's the potential reward here? What's the bottom line? By cutting out those bloated insurer profit margins and high admin fees, companies moving to ASO often see annual savings of 10 to 30% on your total benefits cost. For most businesses, that is a very significant number you can pour back into growing the company. I absolutely love this quote because it just perfectly captures the power shift. Instead of being a player at the casino, always paying the house, an ASO plan means your company becomes the house. You set the rules, you manage the risks, and most importantly, you keep the winnings. So I'll leave you with this one last thought. A traditional benefits plan is a lot like renting an apartment. It's simple, but you're paying someone else's mortgage, and you can't even paint the walls. An ASO plan is like owning your own home. Sure, it's a bit more responsibility, but you build equity, you make the decisions, and you reap all the financial rewards. So the real question is, are you ready to stop renting and start owning?